$45 trillion. That's not a typo. That's the number economist Utsa Patnaik says Britain extracted from India between 1765 and 1938. It's more than the combined GDP of the United States and China today. When she published it, finance ministers scoffed, Twitter erupted, and historians took sides. But almost nobody actually opened the ledger. So we did. This is the full forensic audit. Every mechanism, every dollar, and every number we can't verify. Let's build a receipt. To understand the $45 trillion, you have to start with a single battle and a single bank robbery. June 23, 1757, the Battle of Plassey. The East India Company, a private corporation with its own army, defeats Nawab Siraj-ud-Daulah of Bengal in a fight that historians now know was decided not by military genius, but by a bribe. The EIC paid off the Nawab's own general, Mir Jafar, with promises of the throne. The battle lasted roughly 11 hours. The entire subcontinent's wealthiest province, Bengal, was now effectively a corporate asset. Here's the first entry in our ledger. Bengal's treasury at Murshidabad held an estimated $1.2 million in silver and gold at the time of conquest. Roughly $180 million in today's money. Verify. Robert Clive, the EIC's commander, helped himself personally to $234,000, approximately $35 million in 2024 dollars. Verify. Parliament later called this rapacious and unlawful. Clive called it Tuesday, but that treasury raid is pocket change compared to what came next. The EIC didn't just steal the money in the vault, it seized the tax collection rights. The Diwani of Bengal, Bihar, and Orissa in 1765. These three provinces generated land revenue of roughly $3 million per year, equivalent to around $450 million annually in modern terms. Verify. The company now controlled a tax base roughly the size of France and could spend it however it pleased, which mostly meant more soldiers, more wars, and more territory. This is the founding entry of the colonial balance sheet. Capture the revenue machine, not just the cash on hand. Everything that follows is a variation on that theme. Here's where the accounting gets elegant and sinister. This is the mechanism Utsa Patnaik identified as the core engine of the drain. It's called the council bill system, and once you understand it, you will see it everywhere. Here's how it worked. Indian merchants and exporters wanted to trade with the world. They sold textiles, indigo, saltpeter. European and American buyers needed to pay for Indian goods. Normally, they would send the silver or gold to India. That would enrich India. Instead, the EIC offered buyers a product, council bills. You pay your pounds sterling to the EIC in London. The EIC hands you a paper bill. You send that bill to India. The Indian exporter presents it to the colonial government and gets paid in rupees freshly collected from Indian taxpayers. Follow the money. The export earnings, the hard currency, the sterling, the silver, never touch Indian soil. It goes straight to London. India's export surplus, which ran at approximately 4 million to 5 million per year in the late 18th century, about 600 million to 750 million annually in today's money, verify, was systematically intercepted before it could build Indian capital. Instead, the government just printed more tax obligations on Indian farmers to cover the rupee payouts. Patnaik's central argument is that over 173 years, this compounded transfer, export surplus siphoned through council bills, reinvested at British rates of return, is what produces the $45 trillion headline figure when you apply a modest 5% annual rate of return. Verify. Her methodology uses actual trade data from British parliamentary records. That is rigorous. Her choice of a 5% compound return over 173 years is also where critics say the number balloons beyond defensible territory. We'll audit that in Chapter 6. For now, just remember, the trick is not a robbery at gunpoint. It's a rigged invoice. The council bills mechanism explains India's trade surplus being stolen. But how did the EIC fund its growing empire while India's own economy was being bled? Enter opium, history's most profitable agricultural product, grown by forced cultivation in Bihar and Bengal. The The EIC held a state monopoly on opium production in India. It bought opium from Indian farmers at government-fixed prices, artificially low, roughly 1 rupee per seer, verify, and auctioned it at Calcutta for roughly 10 to 15 times that price. The best years of the Calcutta opium auctions, around the 1820s, 1830s, generated revenues of approximately $3 million to $4 million annually, around $440 million to $580 million in today's terms. Verify. But here's the twist. The EIC couldn't sell opium in China directly because the Chinese emperor had banned it. So the company sold opium to licensed private country traders who smuggled it into China through the Pearl River Delta. Chinese consumers paid in silver. That silver flowed to the private traders, who then, here's the loop, used it to buy council bills in Calcutta to repatriate their profits to London. Council bills again. The opium trade essentially created a second pipeline running the same drain. By 1838, opium accounted for roughly 15% of British India's total government revenue. Verify. China was being hollowed out of its silver reserves. Some historians estimate China lost approximately $1 billion in silver between 1820 and 1850 in today's terms, verify, to fund what was effectively a British corporate balance of payments subsidy. When China tried to stop it, Britain launched the first Opium War in 1839. The bill for that war? Paid in part by Indian taxpayers, which brings us to the next line in the ledger. By 1858, the British Crown had absorbed the EIC outright. The Raj had replaced the company, but the financial architecture didn't change. It got formalized under a concept called the home charges. Home charges were annual payments that India was required to make to Britain, billed as expenses for services rendered. What services? Let's read from the actual ledger. India paid for the EIC's own debt from its wars of conquest. Debts India had no vote in creating, approximately $70 million by the 1860s, equivalent to roughly $10 billion today, verify. India paid for the pensions of British civil servants who had never set foot in India after retirement. India paid for the British Army units stationed in India at Indian expense, including, remarkably, the cost of campaigns in Afghanistan, Abyssinia, and China. The Second Afghan War of 1878-1880 alone cost approximately $19 million, virtually all charged to Indian revenues, around $2.8 billion in today's terms, verify. To be absolutely blunt, Indian farmers, taxed in rupees they sweated to earn, were funding British imperial expansion on 3 continents. And this is not contested history. The home charges are documented in British parliamentary blue books, the government's own records. By the 1880s, home charges ran to approximately $16 million per year, about $2.3 billion annually in today's money, verify. Over the following decades, this became a compounding liability. Indian nationalists, including Dadabhai Naoroji, who first popularized the drain of wealth theory in 1867, calculated that the home charges alone removed more capital from India each year than the entire Indian cotton industry earned in exports. The ledger was designed from the beginning to run one way. All right, we've built the mechanisms. Now let's actually audit the number. Utsa Patnaik's $45 trillion figure comes from her 2017 paper published by Columbia University Press. Her methodology, she calculates the annual transfer of India's export surplus to Britain, the council bills drain, for each year from 1765 to 1938 using British trade records. She then applies a compound interest rate of approximately 5% per year to calculate what that capital would be worth today if India had kept it and invested it. Her raw transfer figure, the actual goods and silver siphoned, she estimates at approximately $9.2 trillion in undiscounted value, verify. The compounding over 173 years is what produces $45 trillion. What holds up? The underlying trade data. British parliamentary records do confirm large and sustained export surpluses from India that were never matched by capital inflows. This is genuinely anomalous for a trading relationship and strongly supports the core drain argument. The home charges are also real, documented, and appalling in their scope. Economist Robert Allen at Oxford independently found evidence of substantial living standard decline in India under colonial rule. Verify. What's contested? The 5% compound return assumption over 173 years. Critics, including some development economists, argue that this is not a realistic counterfactual. Invested capital over that period might have earned much less or faced enormous political and economic disruption, even under Indian control. Reducing the rate to 2% cuts the figure to roughly $12 trillion. Still a staggering indictment, but very different from $45 trillion. Our audit verdict: the mechanism is real, the drain is real, the documentary evidence is solid. The specific $45 trillion figure depends on a counterfactual investment assumption that is contestable. A defensible range is $9 trillion to $45 trillion. Depending on your modeling assumptions, the receipts exist. The exact total is still being argued. That distinction matters more because it's the difference between an airtight legal case and a number you can dismiss. Here's the part where history stops being history. The home charges mechanism, tax in local currency, pay debt service in hard currency, generate export surpluses that never return home, is structurally identical to what the IMF calls structural adjustment today. Here's a live example. Between 1991 and 2006, Argentina, Ghana, Zambia, and Pakistan all received IMF loans with conditions requiring them to run fiscal surpluses to repay dollar-denominated debt. To earn those dollars, they had to export more. To fund the debt service, they cut local spending, education, healthcare, subsidies. The mechanism, domestic taxpayers, taxed in pesos or cedis or kwacha, fund dollar-denominated debt service that flows straight to foreign creditors in New York and London. Sound familiar? Zambia is a useful case study. By 2020, Zambia was spending approximately $1.4 billion per year on external debt service, more than its combined health and education budgets. Verify. Its copper export revenues, the hard currency, were largely intermediated through offshore holding structures, meaning the foreign exchange earned by Zambia's primary resource never fully settled in Zambia. This is not precisely the Council Bill's mechanism, but the directional logic is identical. Local taxation funds external obligations, while export surplus exits. We are not arguing colonialism and development lending are the same thing. They are not. IMF loans are voluntary, at least formally. Conditionality is debated by serious economists on both sides, but the structural parallel is worth understanding. Any system in which a country must earn hard currency through export surpluses to service debts denominated in a foreign currency, while taxing its own population in a weaker local currency, creates an automatic wealth transfer. The Council Bills were the 18th century version. The architecture is 250 years old and still running. Here's the final entry. In 1700, India's share of world GDP was approximately 24%, the largest in the world. Verify. By 1947, when Britain left, it had fallen to roughly 4%. Verify. That is not just poverty. It is the erasure of economic momentum across 200 years of compounding. Whether you accept 45 trillion or 9 trillion or any figure in between, the direction of the ledger is not disputed. Capital flowed out. Infrastructure was built to extract, not to develop. Famines that killed an estimated 12 million to 29 million people between 1876 and 1902, verify, occurred while India continued to export grain to Britain. The audit is damning at any figure. The only real debate is whether the receipt says 9 trillion or 45 trillion. The signature at the bottom doesn't change. The receipts exist. The mechanisms are real. The only debate is whether the total is $9 trillion or $45 trillion. And honestly, at either figure, the verdict doesn't change much. If this audit changed how you think about colonial economics, hit subscribe, because next week we're running the same forensic accounting on a very different empire in a very different part of the world. And if you want to understand how the Council Bills mechanism is operating right now in the 21st century, the video on your screen breaks it down country by country. Was the East India Company the greatest corporate criminal in history, or is applying modern accounting to 18th century imperialism a category error. Build your argument in the comments. I'll be reading everyone.